Good day, Market Chameleons and everyone joining the first time. Thanks for coming by and checking out the Market Chameleon live webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, Market Chameleon, or myself are registered investment advisors or broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. We'll be talking about analyzing large call spread trades with the Market Chameleon call spread screener. How you doing this morning, D?
Good morning, Will. How are you?
Great. Let's add your screen to the stage, and there's the Chameleon landing page. Looks beautiful.
Thank you. Let's come here. So today we're gonna take a look at our call spread screener. Screen out some large call spread trades, and then we're going to use that screener to quickly analyze, even scan with our eyes to see if anything stands out, to take a further look at it based on what we spot. So let's do an example. We're going to go to our screeners up top, and over here, we're going to take a look at our bull call spreads. So these are bullish call spreads. And what we'll do is, well, first, if you're looking at it for the first time, you can see the screener here. Up top, we have different filters with tabs. And then below, we have a data table, which shows different combinations of call spreads and then related analytics and data to that call spread. Okay, so if you're looking from left to right, you can see we got symbol, stock price, market cap. These are analytics for this call spread. So you could see here in NVIDIA, November 21st. Expiration, this is the 225, buying the 225, selling the 230 strike. So that identifies the call spread we're analyzing. And then we have these related analytics where this is the market price of the spread. If we're looking at the displayed ask price, because in the bullish call spread, you're buying it. So we're analyzing the market price that's available, to trade on, where people, market makers are offering it. And then we have these different metrics. So for example, here we see a theoretical price based on historical stock moves. This tells us the difference between the market price and theoretical price. So it's kind of where we're creating a theoretical edge. Here we have based on historical stock moves, the probability of success. But what I want to do first is let's screen out spreads. So these are different combination spreads. But we could have many different combinations and different expirations. And first, we want to take a look at, is anybody trading these specific spreads? Are there large trades? And make that our starting point. We're going to filter the largest trades, and then we're going to quickly use our screener to analyze, if anything sticks out in particular about these large trades, though it may offer an opportunity that we could look into it further. So I'm going to look at this over here. We have this volume analysis tab. Okay, when you click on it, now we have this different set of analytics. So it repeats what call spread we're looking at. And if we go all the way to the right, we actually see if this particular spread, November 21st, 225, 230 call spread, traded as a multi-leg trade. And here it says, well, there are 56 contracts that involved this particular call spread, traded 4 separate times. So 4 different trades at with 56 contracts. And, this is the last time it traded. This is the volume weighted average price with the market at the time and the reference price. So you could see sometimes there are some small trades in it. So NVIDIA has, it's popular. So there are lots of trades going on. We see one with 1,454. Here's one that traded 6 contracts. Some of them don't trade. So what we want to do is first look at the largest volume trades. Okay. And what I'm going to do first is come up here. And since we're defaulted to the next monthly expiration, I'm going to drop this down. And let's look at expirations that expire within the next 30 days. So this is going to expand our potential combinations, because now we're not only looking at one expiration, but any expiration available to trade within the next 30 days. So by clicking it, we're going to see so far we have 37,500 potential candidates. Now we have 131,000, right? Because now you see November 28th expiration here, November 21, all these different expirations available with different combinations of strikes. So once we have that, we could click on this volume, right? Like just click on this volume bar and it's going to sort this table for us. So when you click on it, it'll sort from lows to highs or highs to lows. So the first thing, we've got the lowest. So let's click on it again. And now it's going to resort it from highs to lows. And now we see, larger volumes in some of these spreads. So you could see this particular spread, RGTI, October 31st, 45.49 call spread, traded 30,020 contracts. It traded 2 times, okay, on the day. So this is looking at yesterday's data. We're not open today, so we're looking as of yesterday. It traded 2 times, 30,020 contracts. The last time was 12:03. Okay, so this was looking at the last time it traded for a VWAP price of 55 cents, and this was the market 45 cents 62 cents with the stock reference price of 48.88. Here's one in SPY. This October 31st 705 call spread traded 22,938 contracts, traded 146 times for a VWAP price of 21. So now you could see that we have all these large trades kind of sorted by highest, right, going down. And since we have that and we're looking at large trades, what we could do now is just use our table to see like kind of what sticks out that we might want to go and research further. So if we go back to our summary table, right now that we have these sorted, we could go back to our summary table and we could look at all these different data analytics to see, well, what sticks out. So for example, here in Intel, we see that right now, this particular spread, the November 21st, 40.45 call spread, is offered at $1.97. Historically, we have a theoretical price of $2.15. So this looks like it's trading below that historical average benchmark. That could offer maybe an opportunity if we're looking for bullish spreads to participate on a spread that looks from a historical perspective on the lower end or of the average, okay, by 9.1%. So we could scan that way. We could also look at our table for a positive return if the stock just sits here or goes higher. So percent stock is flat, just by scanning at it, we could see, okay, well, here's one in SPY, right? So in SPY, if the stock just stays here or goes higher, this has a potential return of 40.8% on the amount at risk. So we could see here that here's the offer on this October 29th. We're looking at the 685, 686 call spread. So it's a dollar spread. The offer 71 cents. Well, if you're risking 71 cents, potentially the spread could be worth $1 at expiration if the stock's above 686. Well, that's a 40% return, right? You're risking 71 cents to make 29 cents. That's a 40.8% return amount at risk. And since the stock is already above, it's 687.31, it's above this 686. Basically, as long as it stays above 686, you would achieve that, maximum gain. So that's another way to kind of really quickly scan, for those types of opportunities. We could also go maybe look at so this is looking at the market price versus historical theoretical values or benchmarks based on how the stock moved historically. What if we wanted to look for how the options are lined up, implied volatilities? We could go here, historical IV. And now we have theoretical values based on the implied volatilities of similar options. So now we could see where, things look attractively priced based on the similar options based on their implied volatilities. Okay, where we capture, implied volatilities of option chains and how the options relate to each other. And based on that, we could look for those types of opportunities. If we wanted to look at a strategy payoff, potential payoff, we could come over here. And here we have potential payoffs. We talk about of different types of scenarios. But if we're looking for maybe something, if the stock is up 1 standard deviation at expiration, so we could just quickly scan to see, well, here's 185% return. If that happens, here's 180% return, 156% return on the amount at risk. So these quickly, these different analytics allow us to scan, even with our eyes, a list of stocks that we just basically sorted based on volume that's already trading in those. Somebody is already actively trading these spreads. Some of them have pretty high volume, in the thousands. We could also just do this, say the multi-leg trade volume. Instead of sorting, we could just say 1,000 or more. If we do that, what this does is takes out all the bottom ones. Now we have 174 spreads to analyze, right? So now we know that at least 1,000 contracts are more traded on any of these. And then we could go back to our summary tables and maybe then sort these spreads by, well, let's see, return if the stock is flat. Let's just do this one, for example. So if we click on this, again, this will sort highs to lows, lows to highs. So let's click on it again because we want the largest positives for now. So here's if the stock is flat, 66.7% potential return. This is an Intel, right? The November 21st, 40.41 call spread. The stock's already 41.5. So the market price is 60 cents. So you're risking 60 cents to potentially make 40 cents, right? That's 66% return amount of risk. And we could just go back now to our volume analysis and see, well, what other people do. So you could see that this already traded 2,002 contracts, total volume of contracts. It traded 776 times. The last one was 1121 for an average price of 50 cents, with the market 43 cents, 57 cents. And the stock at the time was 41.58 reference price. So now we know this has been trading, VWAP price of 50 cents. And we also see that the VWAP price is somewhere in between the bid and offer. So not only does this potentially look good, but we have based on our data, a opportunity to potentially get a price that's better than this market price offered, because the market participants are willing to trade it somewhere in between the displayed bid and offer, right? Somewhere kind of right in the middle, right? So if we look, for example, if we look at the market data, here's the market price last was 45 cents, 60 cents. Well, knowing that, hey, there are trades going on, lots of trades going on that are happening in between those markets, potentially we could, try to, if this is the trade that you're interested in, obviously it has to fit all your other parameters, but here's an opportunity to maybe, also participate 50 cents, 51 cents, 49 cents, but there's definitely enough, looks like, trading going on to establish that there are participants willing to trade this spread that you could see here offers price improvement, right? 50 cents where they were trading is lower than the 50-cent offer, higher than 43% bid, but lower than the 50-cent offer, which is in trading, from the perspective of trading, that is actually a significant percentage-wise better price execution, right? Like, think about it. For it to go from 50 cents to 57 cents, what is that, like a 15% return appreciation? So if you could get that execution at 50 cents, right, instead of paying the 57 cents, 15% return, try to make that is very difficult. So these are the types of quick analysis you could even do just by using a table, to sort out your trades that were active in the market. Now I'm going to use this table to kind of scan with my eyes to see what sticks out, if anything in particular interests me to go and do further research. So Will, I'm going to throw it back to you.
Another great webinar, D. Thanks for bringing this to the Chameleon community. It's Wednesday, so we plan on having 2 more webinars this week, tomorrow and Friday. Great job.
Yeah, I think actually Friday I'm not going to be able to do it Friday. I have a meeting that I need to attend.
Awesome. So what we'll do on Friday is I'll send out a pre-recorded webinar, so you'll still get your options education for the day. Great job as always, D. So we have 1 more live webinar of the week, and that is tomorrow. And then Friday you will get a pre-recorded webinar, which is almost as good because the chat is live, just no live Dimitri, which is a bummer. But D's got something he's got to do, which is always good. All right, D, we'll talk later, buddy.
Thanks, everyone. Stay safe out there. Have a great trading day. We hope to see you tomorrow.
All right, see you later, D. Bye-bye. Hey, everyone. Thanks for joining the Market Chameleon community again. Have a safe trading day out there. Jim, I did actually, it was for Cincy. I did have a question. How many messages do you get from the whales a day? If you could type that in so I could see that, I'd be interested to know. And that comes via text, I think, right? Or is it an email you get? Anyways, everyone have a great day and stay safe out there. We'll see you for tomorrow's live show, and enjoy Friday's pre-recorded webinar. And that, remember, is a live chat. So click on at 9. I will try to get on the chat as well. But it will be a pre-recorded webinar. Have a great day, everyone. Bye-bye.